They told you it was just maintenance. They told you it was routine volatility control. They lied. What happened in Shanghai this week wasn't a glitch, it was a purge. In the last 5 trading days, the Shanghai Futures Exchange, SHFE, has suspended 22 major institutional accounts from trading silver. Let that number sink in. 22? These aren't retail gamblers on their iPhones. These aren't small-time speculators flipping contracts for lunch money. These are massive liquidity providers, industrial hedgers, and arbitrage funds. And in a single stroke of a pen, the Chinese regulators kicked them out of the casino. Why would they do this? Why would the second largest economy on Earth suddenly unplug the biggest players in their own precious metals market? Because these 22 accounts were doing the one thing you're never allowed to do in a rigged system. They were buying too much real metal. We are witnessing the Shanghai premium, blowout to levels that are mathematically impossible in a free market. Right now, silver in China is trading significantly higher than silver in New York. We are talking about a premium that has stretched to historic extremes, creating an arbitrage window so wide you could drive a truck through it. These accounts saw the discrepancy. They saw that the paper price in the West was suppressed, while the physical demand in the East was exploding. So they did what any rational capitalist would do. They bought the paper contracts, took delivery, and drained the vaults. But here is where the story gets dark. The Shanghai Futures Exchange didn't let the price run to find equilibrium. They didn't let the market function. Instead, they panic suspended the buyers. They essentially said, if you keep buying physical metal, you're banned. This is the ultimate signal of a run on the bank. When a bank runs out of cash, they lock the doors. When an exchange runs out of silver, they ban the buyers. The mainstream media is completely ignoring this story. If you turn on Bloomberg or CNBC, they are talking about cooling the market or regulatory adjustments. I'm here to tell you that the market isn't cooling. It's freezing up. The plumbing of the global silver market just got clogged in the East. This is exactly what happened right before the nickel squeeze in 2022, but on a much larger scale. The regulators are stepping in to protect the short sellers because the physical inventory, the actual bars in the warehouse, has dropped to a 10-year low. By suspending these 22 accounts, the SHFE has admitted that they cannot meet the delivery demand. They have admitted that the price is fake, and the only way to keep the game going is to physically stop people from hitting the buy button. If you hold silver, you need to understand that the flow of metal has stopped in China. And when the flow stops there, the pressure builds up here. The explosion is coming. Let's break down the mechanics of this, because if you understand why these accounts were banned, you'll understand where the price is going next. For the last month, a massive arbitrage window has been wide open. Traders, specifically the 22 institutional accounts that just got suspended, were executing a strategy that is virtually risk-free but devastating to the establishment. They were buying paper silver cheap on the COMEX in New York and London, taking physical delivery, shipping it to Shanghai, and selling it for a massive profit on the SHFE. This is the silver drain. It sucks physical metal out of the West and locks it into the East. Ideally, arbitrage keeps markets efficient. If the price is high in one place, metal flows there until the price drops. But that didn't happen in Shanghai. The metal flowed in, but the price kept rising. Why? Because the demand in China is insatiable right now. The solar industry, the electric vehicle manufacturers, and the panicked citizens protecting their wealth are swallowing every ounce that hits the dock. The 22 accounts that got suspended were accelerating this process. They were bidding up the price in Shanghai so aggressively that it was threatening to break the London and New York banks, who are short. Think about the counterparty risk. If the Shanghai price goes to $40 while New York is at $30, every bank holding a short position is effectively underwater by billions of dollars. They face immediate margin calls. They have to post collateral to cover the spread. So what did the regulators do? Did they let the price run? No. They suspended the buyers. They literally unplugged the demand side of the machine. This is Price Controls 101. But here is the catch, and this is the part that should make you sit up straight. You can suspend a trading account, but you cannot suspend the laws of physics. The metal is still gone. The inventories in Shanghai are still at decade lows. By banning the buyers, the exchange has tacitly admitted that they are running a naked marketplace. They have sold more paper contracts than they have silver bars. If they allowed those 22 accounts to keep buying, the exchange would have defaulted. They would have had to declare force majeure because the cupboard is bare. They are trying to force the price down by shooting the bidders. It works for a day. It fails forever. This is the equivalent of putting a lid on a boiling pot of water and welding it shut. You stop the steam for a moment, but you're building a bomb. The pressure inside the physical market is building. And without the release valve of legitimate trading, the next move won't be a rally. It will be an explosion. This goes deeper than just a few traders breaking the rules. We need to talk about the silent war happening behind the curtain. Capital controls. China is currently facing a massive currency crisis. The yuan is under immense pressure. bleeding value against the dollar. The real estate market, where most Chinese citizens stored their wealth for decades, has imploded. The stock market is shaky at best. So where does the smart money go when the walls are closing in? Where do the billionaires and the middle class run to protect their purchasing power? They run to hard assets. They run to gold. And now they are running to silver. The government knows this. The CCP understands that if 1.4 billion people decide to dump their yuan for physical metal at the same time, the banking system collapses overnight. So these suspensions are not just about market regulation or cooling speculation. They are a desperate defense measure. The government is effectively saying, you are not allowed to protect your wealth anymore. They are closing the exit doors to keep the capital trapped inside the fiat system. But think about what that means for you, the investor sitting outside of China, if the second largest economy on earth has to ban its own institutions from buying silver because there isn't enough to go around. What is the real value of that metal? Is it $30? Is it $34? Or is it $100? When a government bans buying, it is the ultimate signal of scarcity. Think about it logically. They don't ration sand. They don't ration air. They don't restrict the purchase of things that are abundant. They ration what they are running out of. The 22 accounts were the canaries in the coal mine. They signaled that the vaults are empty and the demand is overwhelming supply. Now the government is trying to hide the body by banning the witnesses. The trap here is thinking that this news is bearish. The mainstream financial press will try to spin this. They will say, oh look, China stopped buying, demand is dropping, price will go down. Do not fall for that lie. China didn't stop wanting silver. They were forced to stop buying paper contracts. Human psychology dictates that the moment you ban something, its value skyrockets. It becomes forbidden fruit. This demand doesn't vanish just because the SHFE suspended an account. It goes underground. It goes into the black market. We're about to see a massive surge in physical smuggling into China. We are going to see premiums on the street detach completely from the official exchange price. The official price might say one thing, but the real price, the price to actually get your hands on metal, will be double. This is the Venezuela moment for the Chinese silver market. The official rate is a fiction. The street rate is the reality. And that invisible, untrackable, explosive demand is about to drain the rest of the world's supply. So here is the verdict. The SHFE suspensions are the smoking gun we have been waiting for. The arbitrage drain became so violent, so undeniable, that the Chinese regulators had to break the market to save the banks. The 22 accounts are not criminals. They are the martyrs of the squeeze. They proved that the emperor has no clothes and no silver. This is the beginning of market fragmentation. We are going to see a world where the price of silver in Shanghai is totally different from the price in New York. The global spot price is a myth that is dying right in front of our eyes. The paper market will say one thing, the physical market will say another, and eventually the exchange with the metal wins. The exchange with the paper burns. Here is your battle plan while the East is in lockdown. 1. Watch the premium, not the price. Ignore the spot price on your screen. That number is generated by high-frequency trading algorithms in London that have never touched a bar of silver in their lives. Instead, watch the difference between the SHFE spot price and the COMEX spot price. If that spread widens again, and it will, the squeeze is back on. The wider that gap gets, the more desperate the banks are becoming. That spread is your real fear gauge. 2. Get physical now. When governments start suspending trading accounts, confiscation is the next logical step in their playbook. If they can freeze an account with a mouse click, they can nationalize a vault with a signature. The counterparty risk just went through the roof. If your silver is in a pooled account, an ETF, or a vault you cannot drive to, you're playing Russian roulette. If you don't hold it, you don't own it. Period. The only way to protect yourself from a suspended exchange is to be your own central bank. 3. Ignore the dip. The algobots are going to read this news as China demand falling because they are programmed to view regulation as bearish. They will try to dump the price, buy that dip. It is a gift from the illiterate machines. They are selling because a government banned buying. Do you realize how insane that logic is? Use their stupidity to lower your dollar cost average. When the physical shortage hits the manufacturing sector, that dip will look like the greatest opportunity of the decade. The system is cracking. They are patching the holes with duct tape and suspension orders. But you cannot print silver. You cannot digitize industrial demand. And you cannot ban math. I want to know who sees the desperation. Drop a comment below with, I see the cracks. If you know that banning buyers is the last step before the explosion, let them suspend the paper. We will take the metal. Stay liquid. Stay dangerous. And remember, when they lock the doors, make sure you are already outside with the goods.